Think about everything you learned in school. You learned how to calculate the area of a triangle. You learned the causes of wars that ended centuries before you were born. You learned how to dissect a frog, recite the periodic table, and analyze the symbolism in novels written by people who died before your grandparents were born. 12 to 16 years of structured education. Hundreds of teachers. Thousands of hours in classrooms. And at the end of it, most people walk out without knowing how interest compounds against them, how to file their own taxes, what a credit score actually measures, or how to invest a single dollar. This is not an accident. It is an absence. And that absence has consequences that follow people for the rest of their lives, in the debt they accumulate, the wealth they never build, the retirement they can't afford, and the financial decisions they make on instinct because nobody ever gave them anything better to work with. This video is what school never gave you. The money curriculum that should have existed. And it starts with the lesson that would have changed everything if you'd learned it at 17. Compounding is the foundational concept of personal finance. It is the reason why small, consistent investments made early produce more wealth than large investments made late. It is the reason why high-interest debt is an emergency and not a monthly inconvenience. It works for you when you invest and against you when you borrow at high rates. Understanding it changes every financial decision a person makes, from whether to pay off a credit card this month to whether to start a retirement account at 22 or 32. It should be taught before algebra. It is more useful than algebra for the overwhelming majority of human lives. The second thing school never taught you is what a credit score is and why it controls more of your life than almost any other three-digit number. Your credit score determines whether you can rent an apartment. It determines the interest rate on your mortgage, and a single percentage point difference on a 30-year mortgage can cost or save you tens of thousands of dollars over the life of the loan. It affects your car insurance premiums in most states. Some employers check it before hiring. It is one of the most consequential numbers attached to your identity, and most young people enter adulthood with no idea how it's calculated, what behaviors build it, or what destroys it. The score is built on 5 factors. Payment history is the largest. Paying bills on time, every time, is the single most important habit for credit health. Credit utilization is second, the percentage of your available credit that you're actually using, with lower being better, ideally below 30%. Length of credit history rewards people who opened accounts early and kept them open. Credit mix rewards having different types of credit responsibly managed. And new inquiries penalize people who apply for multiple credit products in a short period. None of this is complicated. All of it is learnable in an afternoon. But because it was never taught, millions of people damage their credit through completely avoidable mistakes and spend years paying the financial penalty. The third thing school never taught you is the difference between an asset and a liability, and why that distinction is the foundation of every wealth-building decision you will ever make. An asset puts money into your pocket. A liability takes money out. This sounds obvious until you apply it to things people are told are assets. A house you live in, one of the most emotionally loaded financial subjects in existence, costs you money every month in mortgage payments, taxes, insurance, and maintenance. Whether it qualifies as a financial asset depends entirely on the specific numbers of your situation and market. A car loses value the moment it leaves the lot and costs money every month to insure, fuel, and maintain. A rental property that generates more in rent than it costs to own and maintain, that is an asset. A stock portfolio that generates dividends and appreciates, that is an asset. The wealthy build portfolios heavy with assets. People who struggle financially often accumulate liabilities they've been told are assets. The difference between a financially free life and a financially stressed one is not always income. It is often the ratio of assets to liabilities on a personal balance sheet, a document most people have never thought to create. The fourth thing school never taught you is how taxes actually work. Not the civics version, the practical version that affects your paycheck, your investments, and your long-term wealth. Most people don't understand that the United States uses a marginal tax system, meaning that moving into a higher tax bracket doesn't mean all of your income gets taxed at the higher rate, only the income above the threshold does. This misconception causes people to turn down raises or avoid additional income out of a genuine but mistaken belief that earning more will leave them with less. Beyond the basic misunderstanding of brackets, most people have no idea that the tax code contains enormous advantages for people who use them. Retirement accounts like a 401k or IRA allow your investments to grow tax-deferred or tax-free, depending on the type, meaning the government essentially gives you a discount on building wealth. Health savings accounts offer a triple tax advantage that no other vehicle in the code provides. Capital gains are taxed at lower rates than ordinary income. Business owners can deduct expenses that employees cannot. Depreciation on real estate can eliminate taxable income entirely. These are not loopholes for the wealthy. They are written into the tax code specifically to incentivize certain behaviors, saving for retirement, investing in property, building businesses, and they are available to anyone who knows they exist. Financial literacy is, among other things, tax literacy. And tax literacy is worth tens of thousands of dollars over a lifetime to ordinary people who simply learn the rules. Every concept covered in this video, compounding, credit, assets versus liabilities, taxes, opportunity cost, financial freedom, can be learned. None of it requires a finance degree. None of it requires a wealthy starting point. It requires only the decision to learn it and the consistency to apply it. The school system failed to make that decision for you. But you are here. You are watching. And that means the decision has already been made. If this video gave you something you wish you'd been taught years ago, share it with someone who still has time to use it, especially someone young. The earlier this knowledge lands, the more compounding time it has to work. Subscribe if you haven't already and hit the notification bell. Every week this channel covers exactly the financial education that the system left out, explained clearly, practically, and without the complexity that keeps most people from ever starting. The next video is already up, and if today made you think differently about what you know and what you were never shown, the next one will go even deeper into the gap.